Hello everybody, I'm Amit Stavinsky, the Managing Director of Tamar Securities and its subsidiaries, 911 Financial Services and Firefighters United. I'm happy to report that 2023 is shaping up to be a strong year. In fact, this year's positive performance is almost the exact opposite of last year. In 2022, financial markets sold off due to two main factors. One, the fastest increase in inflation of the past 41 years when CPI peaked last June at 9.1% year over year, and the fastest increase in Fed fund rates from 0 to currently 5.25%. It was the fourth worst start to a year in nearly 100 years. It was the first bear market for sovereign bonds since 1949. Both stocks and bonds fell, which produced the worst combined return in more than 90 years. Almost half of the Nasdaq stocks fell at least 50% from their 2021 high, and the average decline of the Russell 2000 stocks was 47%. The 75 fastest growing US stocks corrected more than 69% versus the market from their 2021 peak earlier in the year. Fortunately, I believe that today the market narrative is transitioning from last year's hyperinflation and higher rates to a recession, a rate pause, and eventual lower rates. The two most interest rate sensitive sectors that could benefit the most from such a shift in narrative include fixed income securities and growth stocks, which are also the two overweight sectors in many of our firm's disciplines. Some of the data, in our view, that could lead to either a shallow recession or a slowdown include additional tightening of monetary policy. The effect of the end of the federal debt ceiling impasse could be equivalent, in my opinion, in the end to another 0.25% increase in key federal fund policy rate to 5.25% to 5.5%. This is because the Treasury will need to rebuild its cash balance in its general account, which has been down by $500 billion since January. Over the last 45 years, a recession has always followed the inversion of both the 3-month Treasury bill to the 10-year Treasury bond and the 2-year Treasury bill to the 10-year Treasury bond. Currently, both the 3 months and the 2-year Treasury bills pay higher interest rates than the 10-year Treasury bonds. Also, inversions of the 2 to the 10-year yield that is in play now have been associated with 5 out of the past 6 recessions. Over the past 45 years, when the difference between the present situation index and the expectations index drops below 30, the US economy has always entered a recession. A similar situation to the one we are presently in, with the University of Michigan sentiment survey well below its long-term average after hitting the lowest level in at least 40 years last June. Lately, the outlook for manufacturing conditions in the Philadelphia area fell near its lowest level since 1979. Over the past 45 years, a drop of this magnitude has always been followed by a recession. And as of last May, the Institute for Supply Management showed that manufacturing contracted for the 7th straight months. Since the beginning of the year, the number of Americans filing for unemployment benefits has been on the rise. In the week ending June 3rd, 2023, there were 261,000 initial jobless claims filed, the highest number since October 2021. This is a significant increase from the average of 225,000 claims filed per week in 2022. Banks are sitting on an estimated $2.2 trillion of unrealized losses on securities, according to Stanford University finance professor Amit Seru. Banks also hold about $2.2 trillion in outstanding commercial real estate, and it is during a time of high office vacancy rate of 12.9%, according to the National Association of Realtors. Leading indicators have fallen for 13 consecutive months, the longest since the 24-week streak ended in March of 2009. The share of Americans receiving jobless aid is up nearly 45% from a September low. According to the National Association of Realtors, April existing home sales fell 23.2% from a year earlier. And lastly, 2023 S&P 500 earnings per share estimates are down almost 12% in the past year. That said, historically, bad news for Main Street, such as an imminent recession, was good news for Wall Street, due mostly to the prospects of lower rates. However, I will note that in the past, Fed rate decreases have been extremely rare whenever the unemployment rate has been below 4%, which is the case today. Only 6 out of the past 124 Fed funds rate reductions since 1971 occurred with a sub 4% jobless rate. The stock market has never bottomed before the start of a recession since 1950. It is still not all clear for markets. First, financial markets are entering a seasonal weak period from May to October. The fear index, VIX, is trading near its lowest level in 17 months. And if that trend holds, it would be only the 4th time in the past 5 years that the index moved less than 1% in either direction in a month. According to Bob Farrell, the former head of Merrill Lynch's market analysis, markets are the strongest when they are broad and weakest when they are narrow to a handful of blue chip names. Currently, the 5 biggest stocks, Apple, Microsoft, Alphabet, Amazon, and Nvidia, of which our firm invests in 4 out of the 5 of these names, have a combined market cap of about $8.7 trillion, almost 25% of the S&P 500 entire market cap. What's more, those top 5 stocks have returned an average of 50% in 2023, with some reporting mediocre earnings growth, yet accounting for roughly 80% of the S&P 500 gain. By comparison, the median stock of the index has gained less than 2%, and the equal weighted market cap of the index, in fact, declined 1.2% year to date. The good news, in our opinion, is that the best time to buy equity and fixed income securities is still during a recession, when the market narrative indicates a pause or an interest rate cut. I'm super excited about the future. Inflation is coming down. The consumer price index, the CPI, is down to a 4% increase year over year from a peak of 9.1% increase last June. The producer price index, PPI, is down to a 1.1% increase year over year from a peak of 10.7% increase in April 2021. And as of June 12, 2023, the price of crude oil is down 17% from its peak in October of 2022. Lastly, the US Department of Agriculture projects that food prices will increase only 6.2% in 2023, down from 10.1% in 2022. Although past performance is no guarantee for future returns, as of late, the market's technical analysis has been improving. History suggests that more gains should be on the way. The Nasdaq has traded higher over the remainder of the year 69% of the time, when it has climbed at least 15% through the first 100 days, which is the case today. When the annual CPI rate has declined by at least 5 percentage points over the previous year, similarly to today, the S&P 500 has put up a median return of 14.9% over the following 12 months, according to the data from Bespoke Investment Group. Stocks have historically done well during a Fed pause, according to Jonathan Golub, chief U.S. equity strategist at Credit Suisse, who claims that the S&P 500 has returned 16.9% on average in the 12 months following the last interest rate hike of a cycle, while losing only 1% on average in the year after the first rate cut. Lastly, according to David Donabedian, Chief Investment Officer of CIBC Private Wealth, the market bottoms while the economy is still in recession and begins a recovery. Fast growers such as technology companies look attractive. Price-sales multiples recently reached one of its lowest levels since 1970, and high-quality FANG stocks, fell 30 to 80% from their 2021 highs, and despite their first quarter's market appreciation, they are still on average 30% below their highs. On a price to free cash flow basis, the market has been trading below its long-term average of 25.8 times. In recent years, US companies almost doubled their free cash flow generation as a percentage of sales to above 10%. During the last decade, margins for technology stocks more than doubled the market level. We are living through the fourth industrial revolution in technology that includes Internet of Things, augmented and virtual reality, and artificial intelligence, AI. These are technologies that have the power to change everything about our lives, such as the way we live, work, and socialize. Never before businesses could reach millions of users in the shortest time in history. ChatGPT reached 100 million users in 2 months, whereas Facebook did it in 3.5 years, and WhatsApp in 4 years. AI is probably as important as or bigger than personal computers and mobile phones. Super intelligent AI could boost economic growth by 30 to 100-fold, and AI value is already projected to be 6 times bigger than the internet. It took the internet 24 years to create an enterprise value of $13 trillion. It is estimated that it will take AI only 9 years to create $87 trillion in enterprise value. How can we not be invested in these areas? Thank you for taking the time to watch our mid-year market perspective video.
Artificial intelligence has gained significant attention in recent months due to remarkable advancements made by large language models like ChatGPT-4. Forecasts indicate that by 2030, the AI market could potentially boost economic growth by 30 to 100 times, comparable to the impact of previous turning points like the agricultural and industrial revolutions. ChatGPT-4 represents just one subset of AI, which also includes machine learning, deep learning, robotics, and machine vision. The progress in AI is expected to accelerate even further in the future because of this technology and how it grows exponentially in its capabilities rather than linearly. You might wonder why AI has experienced exponential growth while other technologies have grown linearly. The main driver behind this exponential growth has been the increasing power of semiconductors, following Moore's law, which states that the number of transistors on an integrated circuit will double every 2 years. This growth driver has been effective until now, but as semiconductors approach the sub-4 nanometer level, we encounter physical limitations and the emergence of quantum effects. To bridge this gap and enable AI to continue advancing, graphics processing units, or GPUs, have provided higher levels of computational power. Unlike central processing units, CPUs, GPUs operate in parallel, breaking down problems into millions of tasks and solving them simultaneously. This parallel processing capability theoretically allows GPUs to scale infinitely. The leading GPU manufacturers by market cap include NVIDIA, Advanced Micro Devices, and Intel. Further down the technology stack, a handful of companies play a crucial role in manufacturing chips that drive AI advancement. Taiwan Semiconductors, for example, is responsible for manufacturing 60% of the world's chips, while for advanced semiconductors like those below 4 nanometers, TSMC holds a 90% market share. Beyond chip manufacturing, several companies supply TSMC with the necessary equipment for producing advanced chips. For instance, the photolithography process, which involves using light patterns on photoresist material, is a critical step in semiconductor manufacturing. Specialized companies such as Lam Research, Applied Materials, and ASML are involved in this part of the chip fabrication process. Fabrication is a costly process that requires thorough testing and quality assurance. Electronic design automation, or EDA software, allows chip companies to design, test, and simulate semiconductor functionality before sending them to the foundry. Key players in this domain include National Instruments, Siemens, Cadence Design Systems, and Synopsys. AI workloads also heavily rely on memory-intensive components. Micron Technologies is one of the companies that manufacture dynamic random access memory, or DRAM, and flash memory. During the gold rush, Levi and Strauss sold picks and shovels rather than panning for gold. Investing in artificial intelligence today goes beyond big tech giants like Microsoft, Google, and Amazon. And there are numerous publicly traded companies throughout the AI supply chain that offer investment opportunities akin to the picks and shovels of the AI revolution. And just like the gold rush, the rapid advancement of AI technologies necessitates that every investor stand up and pay attention. Looking back, it took the internet 7 years to reach 100 million users. It took Instagram to achieve the same milestone in just 2.5 years. And fast forward to today, OpenAI's ChatGPT reached 100 million users in only 2 months. This is exponential growth by definition, and precisely the types of supply chains we're traversing to identify the deep value which will lead to the next technological gold rush of our modern day.
In 2022, the narrative in markets centered around inflation and rising interest rates by the Federal Reserve. The Fed embarked on a series of 10 rate hikes to combat inflation, which had spiked to 9.1% in June of last year, the highest level we've seen in 40 years. Thus far, the Fed's actions appear to be successful in cooling inflation. However, there is a concern that the Fed may have overshot on their policy and caused a recession. If that is the case, the narrative will shift from rising interest rates and high inflation to a recession and lower interest rates. This would benefit growth in technology stocks as well as fixed income, which were actually the worst performing sectors last year. With 16 different investment disciplines, from the most conservative to the most aggressive, our firm's active management focuses on taking advantage of these changes in market cycles and helps prepare our clients' portfolios accordingly.